Good morning and welcome back to the latest edition of the InvestTalk market analysis for the week ending June 30th, 2023. We are entering the month of July, and that means the second quarter is over. The first half is over, and that's why I'm titling this video Q2 ends with a bang and weak inflation numbers. So I'm Justin Klein. Just a reminder to subscribe to this video or this channel as well as our podcast InvestTalk. I am the host of InvestTalk, and I'm excited to go over all the data with you here that came in this week on the economic side and then dig into the charts. Now, on Monday, you had the Richmond Fed Manufacturing Index that came in at -7, so still shrinking on the manufacturing side, but an improvement from the last 2 months when there was -15 and -10. Okay, new single-family homes sold just powering higher. We've talked about this many times. New home market is where the new inventory is coming from. Since most people are locked in at 3%, they don't want to trade out of that 3% mortgage. Okay, because pending home sales actually ticked down a bit, right? Down 22% year over year versus 20% year over year in April. So clearly, when it comes to the whole housing market, not a whole lot of movement, especially compared to where we were last year, but it's mainly on the new home side. Now, durable goods new orders month over month up 1.75%. So 3 months in a row of growth. So the durable goods side, that seems to be relatively strong. Total vehicle sales did tick down here. Obviously, higher interest rates are slowing that part of the economy down, but there's a lot of pent-up demand, and the people were having trouble getting into new cars, finding a new car, and that's balancing out more, but there's still a lot of pent-up demand, and I think that's what's keeping the auto market relatively buoyant. Now, initial jobless claims, that ticked down dramatically, 239,000 after just continuously powering higher for the past few weeks. But this continues to show you that the jobs market, while not amazing, is not weakening in a significant way. So it's kind of a confounding issue for a lot of people, but it's the way it is, and you have to pay attention to the data that is coming in. Now, the real GDP number, quarter over quarter, up 2% in the first quarter. This is revised. I believe it was revised up slightly for the first quarter, but obviously that's very lagging data. And, in the investing world, you want to be looking forward. Now, speaking of looking forward, the market's always focused on the Fed, and the Fed focuses on inflation. And a lot of people look at CPI or maybe even PPI, but this is where the Fed tends to focus, which is the PCE price index, personal consumption expenditures. And what you see here is we have a 3-handle, folks. We have a 3-handle. We've been saying for since the beginning of the year that, hey, inflation is going to continue to decelerate through the year, and especially in the back half of the year. June will probably be where it really accelerates, but you're starting to see that a bit in May. So that's another reason why the market finished strong this week, because this number came out on Friday, and I don't think a lot of people talked about it, but the market was up big, and it was expectation that, hey, maybe the Fed doesn't need to be as hawkish going forward because this inflation data continues to come in weaker. Consumer sentiment also stronger, probably because of inflation, right? A big reason why the consumer sentiment was so weak last year, it was mainly because of inflation, right? Yeah, you have a job, but if you don't feel like you can afford your day-to-day life, then you're going to be less confident about what's happening in the economy. But now that inflation is ebbing and the headline numbers are definitely coming down, the month-over-month numbers are certainly back to reasonable numbers. I think the consumer is getting more confident. I'm hearing anecdotally from business owners that I know that produce physical goods, the business is doing okay. And it's actually accelerating here, especially in the retail side. So I thought that was interesting. Now, this all goes to this number, though, which is the chance of a recession going out in the future, a year from now. And remember, see, this is looking at 2024, next year, a 70% chance. And I think there's certainly a possibility that we do enter a recession later this year. But once again, I have to repeat it time and time again. Not every recession is created equal. Not every recession is '08. '08 was a financial crisis. Most recessions are pretty mild. And it's very difficult to have a major recession when you have a few things lined up right now. Jobs market, once again, pretty strong. You have a lot of money on the sidelines. So, there's not a whole lot of, there's a lot of dry powder if you get volatility in the markets from people to go out there and spend. And people are getting paid 5% on their cash, like for the first time that they've, I don't want to say in my lifetime, but in a long, long time. So it's certainly a different dynamic out there than '08, and you have to take that into consideration that a recession isn't the end of the world, and oftentimes, markets can stay buoyant and even bottom before a recession. Now, this is interesting. It was the crude oil production. Now this is lagging. It was in April, but we did tick down in April in oil production. So as we go into the back half of the year, I've been saying we expect the first half to be choppy in the energy space and the back half to be better. And that was another indicator that we're not turning on the spigots as much as we have in the past. Now the Fed watch tool here, it is showing still an 86% chance of a rate hike on July 26th. But we're still we're nearly 4 weeks away from that. So still a while before we get there. So that was the economic data that came in today. We continue to see this very mixed picture, but an economy that's slowing, but at a very measured pace and nothing too dire about it overall. Okay. Let's touch on the MOVE index. I love that because I love to focus on the bond market and see what kind of stability there is there. And so far, it remains subdued, which is a positive for asset prices. And you saw the S&P up. That's the SOX. That is the semiconductor, which this was interesting that it didn't really make new highs, even though, look in the S&P, it did make new highs. So that's a bit of a divergence there in the semiconductor space. But the S&P is up into a little bit of resistance. I still think we're in more of a choppy to up period. So would surprise me if we get a major breakout to 4,600 anytime soon. But we did have a nice close to the week. You had the NYSE. That one also closed the highest close since, what is this, March? What are we back here? Yeah, the highest close since, February. So markets are definitely on a march higher. And what you're getting here, though, is the growth side of the market was doing very, very well and drastically outperforming the value side. And this is chopped sideways really for the entire month of June. Okay, so the month of June, growth versus value, they were pretty even after, once again, that growth just outperforming. And is this the start of a trend change that, hey, maybe growth is not going to perform quite as well, but now the value side is going to bring up the rear. And that could continue to power markets higher. You look at this MACD here, it's just showing that there's likely a rollover here. It doesn't mean the market has to roll over, but it looks like that shift from leadership of the growth side of the market to the value side of the market is getting close. And once you have this strong momentum on the upside and that momentum wanes, like you've seen over the past month, that ultimately typically means a reversal. So we'll see. We'll keep an eye out on that. Now, the broad VIX, this just powers down into the 13 level. I mean, this is, you could say borderline complacent, and you'd probably be right, but it doesn't mean that this has to turn into some sort of fall spike anytime soon. This could meander down here in the low to mid-teens for a long time, just like it did for much of 2021 when markets were very strong, right? You had little perks up in volatility, but ultimately every little increase was beat back down, and that was obviously positive for risk assets. So you could certainly see market like that. Now let's look at the short-term junk market to the short-term treasuries, and this continues to go up, right? Look at this closing to the highest level since March, and it just shows you the credit markets are hanging in there just fine. Even if you look at junk bonds more broadly to like a treasuries, looks strong, okay? Commercial mortgage-backed securities, I'm definitely watching this because it's definitely an area where there's more strain on this sector with the office problems. We did a webinar on Wednesday. Thank you all for tuning into that. But this is something that I will continue to watch, see if this is another rollover that would maybe signal more stress in the credit markets. But so far, looks okay. The dollar had an up week, but still struggling to really gain major traction to the upside. Overall, this has been a choppy period, and obviously, you want to see lower dollar in order to get asset prices to stay buoyant. And so far, you haven't really had a breakout to the upside. If you do, then I would worry about, about weakness in asset prices. Let's look at gold. Here's GDX. It attempted to break below the 200 moving average and it reversed. So this is a nice positive reversal. And I think this is on the back of those PCE numbers showing that, hey, and it sounds counterintuitive, you think, oh, lower inflation, that might be bad for gold. But it actually isn't, because what happens is it gives more leeway for the Fed to be less hawkish and more dovish, and obviously easier monetary policy tends to be good for gold prices. So the GDX reversed, the GLD that also reversed off of some support. So what you can see here, it's a good technical analysis here. You have this breakdown and a reversal breakout, and you found support at the start of that breakout, right? We broke out above this kind of level right now at 175 in the GLD 176 area, and that's where you found support. We'll see if we can get some follow through into next week, but certainly on watch, and I think that's showing some nice signs of strength in an overall broader uptrend. XLE, same thing. You've had this pullback and trying to break down and just can't. And it continues to reverse this week. Very, very strong week for the energy space. The materials as well, that one powering to the highest levels since April, and some positive out of that. If you look at industrials, that also is breaking out to new 52-week high. New 52-week high. So this is the market telling you the economy is hanging in there. Okay, the transportation index, take a look at that, also trying to break out as well. So overall, I've been saying this for a while. I know it sounds counterintuitive and everyone wants to be negative, but you have to be constructive on this market overall. Neutral to bullish. The fundamentals are, while not amazing, are hanging in there. Liquidity dynamics are improving. And ultimately, that manifests in the dollar having trouble breaking out, the VIX staying at low levels, credit indicators saying everything is fine, right? Overall, obviously you're gonna have pockets of weakness here and there, but there's no broad-based dramatic credit deterioration. And so, well, the market's a little overbought right now. Let's go to NYSE. Market's a little overbought. I still see choppy to upside for probably the foreseeable future. Now, you get through the summer, into the fall, that could be a time where things could change. But ultimately, right now, there's a lot of room for the market to move to the upside. Sentiment is improving, but it's not an extreme level. And what do you say? The pendulum goes back and forth. You had pendulum very negative in the fall of last year, which was the best time to buy. I was talking to potential clients, current clients, and they were all negative on the market. And I was saying that, oftentimes when people are most negative, that's the best time to buy, because the hand of governments are forced. You saw the problems in the UK gilt market, in the Japanese JGB market, and all of that made it imperative for the powers that be, the central banks, to bring liquidity back into the system in order to not break things in a major way. And that's what you've seen so far. And they continue to go down that road. And there'll be more excuses as inflation continues to decelerate in the back half of the year for them to keep pulling their foot off of the brake, which they did in a big way last year and into this year. So that's where we're at. And I know it's problematic for a lot of people's narratives, with what's going on in the housing market slowing, right? They think, oh, housing's slowing, housing's bad. Oh, wait, it's going to happen again, and everything's going to fall apart. Every cycle is different, and you have to accept that, and you have to look for it as it is, not as you hope it to be or you wish it to be, or uh, what backs your political narrative or whatever. Whether you like who's in power or you don't like who's in power, that should be irrelevant to your decision making process. It should be about what data are you seeing come in, and hopefully I gave you a good overview of that data, both on the economic side and the technical side for this week. And I appreciate you all tuning in, and once again subscribing to this channel as well as our podcast InvestTalk. And I want to remind you that the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KPP Financial or those associated. I hope everyone has a wonderful holiday weekend. Stay safe out there, and I'll talk to you all soon.